Hi, I'm Christine Benz from Morningstar.com. The optimal asset allocation is a moving target. I recently discussed asset allocation by age band with Vanguard's Maria Bruno, who shared some insights on this important topic. Maria, thank you so much for being here.
Good to be here, thank you.
There has been a lot made of how millennials are investing, and following the financial crisis, there were some data points suggesting that they were feeling pretty conservative, that maybe they were investing pretty conservatively. Your data don't really show that. Let's talk about that.
Yes, this is actually quite interesting because there's a lot of headline news around millennials being scared of the stock market and not being appropriately allocated. And survey results show that as well. But when we actually looked at our clients in terms of how they're investing in their retirement plans, it's actually a very different story. So for instance, within our 401k participants, so the accounts that we actually record keep here at Vanguard, we found that the average equity exposure among millennials was about 85%. Then when we also looked at IRA investor behavior and millennials in particular, we found similar trends there. Around 85% of their exposure was within equities. And then we also looked at industry data. So the Investment Company Institute released some statistics this year, and very similar in terms of IRA allocations among millennials is about 80-85% equities. So it's actually a very positive story. So even though they're saying that they're scared of the stock market, they're actually in their retirement accounts well allocated, which is a very positive story.
So let's talk about the disconnect, why even though they're anxious, you may be seeing these sort of age-appropriate levels of equity allocations. Why might that be?
So the why behind that, we really can point towards the evolution within 401k plan design. So I think two things in particular. First is qualified default investment options. So most employer plans will offer qualified default investment options, and 8 in 10 employers will choose a balanced fund or a target date fund as a default. Furthermore, there's the auto-enrollment feature. So about 40% of plans, at least here at Vanguard, the plans that we record keep, about 40% of the plan sponsors offer auto-enrollment. And then among millennials, what we see is about 85% of millennials, when offered auto-enrollment, actually take advantage of that. So they're being opted into the plan and opted into a balanced fund, which is actually doing really great steps towards asset allocation for this cohort. And then I think what we're also seeing is those types of investment tendencies also porting over into the IRA space as well.
Okay. So looking at a slightly higher age band, even folks who presumably are well into their retirement years, I was struck by the data that you had showing actually fairly high equity allocations among this set. So I think the average equity allocation for folks who are 85 was upwards of 50%. Why do you think people are maintaining such equity-heavy stances well into retirement?
Yeah, we found this interesting as well, too. So we have this conventional glide path where their investors are more heavily allocated towards equities early on and then moving to a more conservative posture throughout retirement. But what we found was that our retirees actually stay well balanced within their IRAs. So when we think intuitively why this might be, it could be a couple things. First is, I would attribute it to maybe inertia. So the markets have been very generous over the past 5+ years, and perhaps retirees are not rebalancing. We know behaviorally rebalancing can be a little difficult. So part of that could just be the trend toward not rebalancing. The other might be in terms of they may not need their IRA to meet their spending needs. Particularly with Roths, we saw slightly higher equity allocations within Roths. So that could then cause us to question, well, how are they thinking about their Roths? Could it be for legacy planning or passing on to their heirs? So they may be thinking not about their time horizon, but also that of their beneficiaries, which might also warrant a more aggressive posture. So probably a couple key things maybe as we start to look at this a little bit more deeply in terms of why we're seeing this.
Okay, before we leave Roths, let's just quickly discuss from a planning perspective why Roths are often thought of as a good vehicle if you do want to pass assets to your heirs.
Roths are actually an excellent estate planning tool because essentially what you're doing there is passing an asset without an embedded tax liability. So traditional tax-deferred IRAs, for instance, your beneficiaries would have to take distributions but also pay income taxes on those distributions. Roths, while distributions will be required by beneficiaries, they're tax-free. So you remove that inherent income tax liability to your beneficiaries. So from an estate planning standpoint, passing those types of assets to your beneficiary, they grow tax-free, it can be very beneficial.
Okay. So drilling into the data a little bit more, you have been looking at foreign allocations, foreign equity allocations as a percentage of the total equity allocation. What your data would show is that investors are generally feeling a little more comfortable with global exposure. Let's talk about that finding.
Sure. So once we looked at the asset allocation, then we looked more deeply in terms of, all right, how are our investors looking at U.S. versus non-U.S.? So we are seeing a more appetite towards global investing. So those investors who actually had equities within their IRAs, about 75% of those investors actually held non-U.S. stocks, or I should say had exposure to non-U.S. But then we looked to see, well, how much are they holding? And there we're actually seeing a U.S. home bias. So we're seeing about a 20-25% allocation to non-U.S. for those investors that hold international stocks.
So of the total equity weighting, about 20-25% was in foreign stocks.
Correct. And that's much lower than what we would generally recommend. For instance, if you look at our target date funds, it's about 40% non-U.S. exposure. So there does seem to be still a U.S. home bias. So that was interesting. And the other thing, too, is how are they getting this equity exposure? So certainly, investors who are in target date funds are well allocated because the fund is doing the portfolio management and rebalancing at the asset and sub-asset level. But what was interesting we found, too, is that some investors, or a good part of the investors, are actually getting their non-U.S. exposure through active mandates, not explicit non-U.S. funds.
Okay, so they might be funds that have mainly U.S. stocks but a little bit of foreign, and so investors are getting it indirect.
Correct. Either balanced funds that might have that, or most likely active mandates that might have the ability to invest abroad.
Okay, Maria, interesting set of findings. Thank you so much for being here to share them with us.
Great, thank you.